We are now in the closing bell market zone. Treasury Partners founding principal and CIO Richard Saperstein is with us, and CNBC senior markets commentator, of course, Michael Santoli is here as well to break down these crucial moments of the trading day. It's good to catch up with you. All right, heading into a new year, how do you feel about this market? What are you telling your clients?
I feel good. We have a good backdrop of conditions with moderate inflation, strong employment, strong growth, deregulation, permitting. Stocks are at high multiples, but there's still excellent opportunities now in the market.
Wow. What if the Fed doesn't cut next year? I mean, is the Fed a risk at all in your mind?
No, Fed is neutral to accommodative. I don't think they're going to have an impact because earnings are going to be up 13, 14% next year. Half of that is going to be large cap tech. Roughly 10, 12% will be financials. So if you want to swim where the fish are, you just want to focus on those industry groups.
Well, some people are trying to swim in a different area of the pond now, right? Everybody was swimming in the same area, got kind of crowded in tech, and now they're trying to find out where the fish are going next. Right?
Yeah, we've been hearing that for years.
And you don't buy it?
No, because for the last 3 years, we've been in a tech bubble. It's been overpriced. But if you look at some of the companies, take Amazon, for example, their multiple actually dropped 20% year over year because their earnings were up 28%. And there's two other tech stocks that actually have not had an increase in multiple, large cap tech. So I'd focus on the hyperscalers and the peripheral companies around them.
What is this then in the market the last week or so? Like what is this showing?
We've had setbacks with DeepSeek, with Liberation Day, with the credit crisis of large cap tech. So all these setbacks present investment opportunities relative for a long-term investor.
I know, but aren't you telling me, though, that more cyclical areas of the market are going to do well next year for the backdrop that you just painted for our viewers?
They will, but I would focus on where is the growth. I'd focus on financials and, of course, my favorite, independent power producers.
Still? You're still on that trade?
We are underpowered in this country, and the demand is only going to increase. So for a long-term investor, keep in mind, I've owned the large cap tech stocks for 10, 12, 14 years. So it's been a great way to build wealth. It will continue to be, and setbacks like this, your listeners should be adding in periods like this.
Well, let's bring Mike into the conversation, too. It's like, don't believe the hype of all these other areas. What do you say?
I mean, look, everything at a price, and I think the market even saw that today. You know, in the middle of the day, I was saying, maybe, we get through this period, and everyone says, we have the old mega cap leaders on sale. It almost happened in the last 2 hours, okay? That's what kind of rescued the indexes from this other test, the S&P of the 50-day moving average. Tesla makes a new high, and it's Mag 7 again. So the market is finding a way to play a little bit of defense using those stocks. We do have a little bit of a sense out there that with the soft economic data in the very short term, I'm talking tactically, that maybe the industrials and the banks and the consumer cyclicals did what they could for us up to this point. So I don't know if that means we're not going to have the big broadening rotation, or it means it's just going to be this sort of constant churn. But today it did seem as if, the majority of the Mag 7 are double-digit % below their highs. So in other words, except for Tesla, you're not kind of buying the peak. So we'll see. I don't know if we're going to get past the kind of CapEx vigilante story, the overinvestment fear, and all the rest of it. But at the moment, it felt as if the market felt it had gone far enough, that rotation.
How do you address that and those concerns around AI?
I think that we've had different types of bubbles. In 2008, we had a leveraged financial crisis. Banks were leveraged. They created leveraged products. Borrowers were leveraged. That was an unproductive bubble, and it led to the crisis. Here, we're talking about a bubble in multiples, yet we're still reinvesting free operating cash flow into this new technology. Companies with 2 and 3-quarter backlogs now have 2 and 3 year backlogs, and that's going to continue. I'm not talking about the Oracle, OpenAI financing bit. I'm talking about the large hyperscalers that have the operating cash flow to fund this build-out.
I know, but what if we have a spending in the build-out itself? I mean, a bubble in the build-out itself and in spending in general.
Key word is fungibility. If you listen to Microsoft's last call, Satya Nadella talked about the fungibility. Remember, roughly 45-50% of data is on-premise. That can go to 80% in the cloud. So fungibility of these data centers is key to this build-out.
I mean, I don't think we have to be in a bubble for the market to say we're going to take a break for a while from the expensive tech side. I mean, and that has happened multiple times. So I try to sort of sidestep, the argument, maybe the risk reward's better elsewhere, is not answered by, yeah, but it's not a bad bubble, okay? Because you can still be outside of a bubble or in the bubble in the making or 2 years away and still have the risk reward not look great. We weren't in a bubble at the beginning of 2022. NASDAQ went down 30%. It can happen. It's just one of those things where you can kind of use semantics to talk around the edges. I do think the market's very fully subscribed to the idea we're getting an economic pickup in the first part of next year. I don't think there's a lot to say that's going to be wrong at this moment. I do think the Fed is getting some ammo in oil prices cracking hard to 4.5-year lows and inflation expectations being subdued and the uptick in the unemployment rate for them to be on the mark and say we're ready to ease further if we have to.
You sound, but looking at your mix of where you want people to be, that you're pretty close to 60-40. You may be 50-40-10 in terms of alts, but you're not leaning heavy in any way towards alts. You're like 0 to 10%.
Right. We have very, very low exposure as per the industry to alts. They're illiquid, they're expensive, and they're not very transparent. I want to have liquidity here. I want to take advantage of current opportunities. And as I mentioned previously, we have the ability to buy municipal bonds at 4.5% tax-free.
Man, you're one of like the few financial advisors of your caliber who is telling that story about alts. Everybody's like running their clients into them, and you're actually willing to call it out.
Yeah, we go the other way.
Saps.
That's it.
Well, I mean, I guess you got to be a contrarian. Bonds, 30 to 40%?
Yeah, we've been pairing equity because it's grown over the last 3 years. Markets are up 100%. We've been peeling back some equity and adding to tax-free munis.
All right.
And that we could take to the bank every day.
All right. Well, it's an interesting story. That's why we like talking to you. Not afraid to go against the grain. That's why he's one of the top financial advisors in the country, I guess. Rich Saperstein, thanks for being here. Mike, thanks to you as well.